always to bring on board Maneesh Dangi to talk about macros, investing, real returns, bond versus equities. Always our favorite discussion. I always say equities, Maneesh will say bonds. Let's see how that discussion is going today. But Maneesh Dangi joins us in his new capacity. But today we'll formally introduce him in his new capacity, which is founder of Mosaic Investing. What an inspiring name, right? Mosaic means collection of a lot of things, right?
Yes, collection of all sorts of different diverse elements, but if they can be put in coherently. So although different, like in our family, right? You, your wife and kids are so different, and yet there is a unity in it.
Right.
That's Mosaic, So diverse elements coming together. So we call it Mosaic Asset Management.
Wonderful. How's the firm going?
Good. Early days. We've been launching the first fund in October.
It's open for public now.
Open for public now.
Okay. So what are you telling your clients now at this current juncture? It's been very easy. If you bought gold, you've made money. You bought equities, you've made money. Fixed income has given great returns, and even real estate has appreciated.
Yes.
So in this market, if somebody is looking at generating superior returns when everything is at an all-time high, how should one approach the market?
Basically, if everything has made money, you ought to be now cautious that, and our job is to figure if something is wrong somewhere. So you would say that as of right now, given that economies across the world, more specifically in US, is slowing. Also in India, you have some kinks. It's sort of fairly plausible that rates go further down. As we've discussed a couple of times in last 6-8 months, that rates in India could get to 5.5 or thereabouts. So there is still a runway there. I think I like that space. I think the bond yields in India will be sharply lower in next 1-2 years, perhaps even lower than what we saw in COVID. Gold could be a small allocation. Again, it likes the fact that real yields in US will come down. So therefore, it's done really well already. So to that extent, you should be cautious there. Because gold, you have to be worried that it tends to get into these phases where for a long time it doesn't perform. So you never scale the allocation there. There is no coupon in gold, right? So be careful there. Equity is a space where there's a lot of momentum. The margins sort of remains high both in US and India, but the revenue sort of has started to come off. Even EBITDA and PAT sort of in India last quarter numbers were not that great. So you ought to be cautious, that remains my view. Now, when
cautious on equities?
Yes.
Bullish on bonds?
Very bullish on bonds.
And neutral on gold?
Neutral on gold. And I can actually, because, we've launched this strategy, I think, from a purely, because I'm more of a macro top-down, what is good guy. And I think it's sort of reasonable to assume that even though India enters in a slowdown, because it's likely that, Indian balance sheets are so clean that the slowdown won't hurt them much. So even though the pressure on P&L appears, the margins will come down and disappoint equity markets. Balance sheets are squeaky clean, and therefore they'll be able to service the loans. So if you can get great opportunities in lending, I think there is a decent risk premium to make. My sense is that people who can afford and can move to high yield strategies, ours and many other such strategies exist. I think it's a better place to hide yourself. That's the way to actually play growth or play extra risk premium versus equity right now.
Okay. A bond investor always looks at balance sheet. Equity investor always looks at P&L.
We discussed about
We've
this.
discussed this much. I mean, I'm learning these things from you.
Yeah. Bond meaning a corporate bond investor or a high yield, most importantly. If you're investing in AAA, if you're investing in AAA government bond, you're looking at inflation.
Okay.
That's your worry. If you're looking in credit, you're looking at survival, and which is mostly balance sheet. The protection gear, for a balance sheet, for Nikunj, me, and any company comes from how strong our balance sheet is, how much leverage we have, right? So I think a bond investor, as you said, mostly a credit guy, actually looks at balance sheet. Of course, equity also looks at balance sheet, but predominantly driven by margins, P&L, growth in the profit, and so on and so forth.
Okay, so we'll today make the show very simple, just for the audience, so that they can relate to it. You are of the view that there would be a engineered or perhaps a base effect which would kick in, and slowdown will be there in FY25 and FY26. Slowdown does not mean you're not growing. So that's a great place to be in for a bond investor. because you are growing, which means there is no risk. And when the slowdown happens, interest rates comes down. Is that the thesis what you're trying to perhaps share with us?
Yeah, so basically I'm saying this is sort of it's not a 2008 crisis, okay, because leverage in US is not so high. India also, given that after all this growth, corporates haven't levered. So in a sense, India also would not experience anything like what we saw post ILFS or post 2008, right? So even though we will slow down, household balance sheets are a bit levered now, global slowdown will affect us, but it won't mean that we collapse. So in a sense, it's a little bit of a midway, a typical business cycle slowdown, but not a crisis. So that's my narrative. But then it's likely that central bankers will have a lot of opportunity to cut rates. I think I wouldn't be surprised if India cuts rates much more sharply. Right now, sort of markets, Nikunja, are baking in very, very light touch rate cut environment in India. Even in US, though it has aligned to what I thought 5-6 months ago, I still think that it's we're going to be more like where we were in 2019. So somewhere at 2% or 1.5% in terms of Fed rate. So markets right now are baking in 3.5. So I think there is still a lot of space for the rates to actually ease at margin versus what is being expected right now.
Okay. One is a simple macro trade, which is that rates come down, you make money in the bond market. Now let's look at the corporate bond market, which is where you specialize in. Corporates, when they need to grow, they need capital, and they go to the bond market or they go to the equity market. But when equity markets are so strong,
yes,
corporates may say, why we have to go to the bond market?
Yes.
Everybody is doing a QIP or an IPO or raising money, or even promoters are selling. So this entire premium which corporates were getting from the bond market because of the liquidity in the equity market, will that go down?
So see, there are two things. One, of course, when you raise money in bonds, you get a tax shield, isn't it? So it's a tax deductible, it's an expense, whereas equity is not. So to that extent, your reflex is always that if it's a money that you need, Nikunj, for shorter term, it's 3, 4, 5 years, and profits will take care of whatever you require in any case over a long period of time. You don't want to raise money. So you don't want to raise money through equity, instead you do bond. But yes, you are absolutely right. At current valuations, most corporates are encouraged to borrow, to raise as much equity as they should.
I mean, look at Vodafone.
Yes.
They actually raised capital and they were able to take care of the entire debt obligations.
Yeah, I mean, we can't name names now, but I mean, almost bankrupt firms now, firms which have always languished, funds who have had patchy track records. All of them are able to raise money in equity. So it's a wonderful time.
So then what is the charm of investing in the bond market?
No, I'm saying, promoter must raise money in equity. That is very clear. Investor mustn't invest in equity in some of these dodgy firms, firms with patchy track record. What is the charm of bond investing is that there are always opportunities which actually displaces equity. In a sense, if Nikunj wants money only for 3 years and thereafter, of course, cash flows will be sufficient, why would you like to raise a perpetuity? Equity is forever you're diluting, right?
EPS ultimately gets impacted.
Huh?
EPS gets impacted.
Yes. So you won't like to dilute. So which is why you would say that let's raise money at 15-16% for shorter tenor for 2-3 years. So I think, this opportunity, good times, bad times will always exist.
Okay. Now in this wonderful note which I have in my hand, and you've done a lot of in-depth analysis of long-term cycles here. You are focusing this entire thesis on 3 pillars: nominal returns, real returns, and risk premium. What are nominal returns for equity shareholders in last 10 years? And history is any benchmark to go by. What should be the nominal returns in next 10 years? First, what are nominal returns and what have been the nominal returns of the Sensex?
So nominal returns are the returns that you think and we all talk about, which is, how, let's say if Sensex moves from 80,000 to 1,60,000, nominal returns are 100%, isn't it? So, the way to look at it, a lot of people tell us that, equity is about long-term investing. So I kind of looked at 10-year rolling returns of the last 30-40 years. And
what are rolling returns?
Rolling returns mean, let's say if you invested in 2004 and divested in, or rather exited in 2014, you got, for 10 years, you got some return.
Okay.
Right? So I'm assuming that you are a very patient investor and stay invested for 10 years. So every time you put in money, every quarter of 1992, 93, 94, 94, 95, and then exit only after 10 years. So then you get a return of 20, 30, 40 years, right? On a rolling 10-year basis. Now, if I do a median of that return, so that kind of gives you an impression that, okay, on average, an investor who invested for 10 years, what kind of returns he got? That number is more like 11, 12%.
Okay.